Hello everyone, my name is Rick Happle, Portfolio Manager at Jaffe Tilschen Wealth Management. It's October 4th, 2023. The title of my talk today is Constructing Portfolios with Certainty in an Uncertain Time. Let me begin with a three-part top-down overview. Retirement, the economy, and bonds and stock markets. Retirement. 3 points here. Number one, the riskiest time to invest is when you're a pre-retiree or a young retiree, because declines early in retirement eliminate income opportunities forever. Number two, you have to have a comprehensive retirement plan to avoid underspending, which people actually will do, or overspending, which is much more common. But inflation is your biggest threat. For example, here is $1 million. With the way inflation is headed, maybe this will be a real currency one day. Right? But when I was a young teenager, I said to my dad once, "So tell me, Dad, just how much is $1 million?" And he said to me, "Rick, if you had $1 million today, there's no way you could spend all the interest." Now, back then, interest rates were between 4 and 5%. The median income was $4,500. So it's pretty amazing. If you look at today, what $1 million will buy with the 4% distribution rule, it's really 40 or 50,000 of annual income before tax. So big change. Inflation is going to have an impact on retirement. The economy. It looks like the government is likely to shut down now that we don't have a speaker. Federal spending is out of control. The consumer is out of COVID cash. Oil is $88. Mortgages are 7.5%, and consumer credit using a credit card is up to 24%. So I think we've got some headwinds for the economy here. We've had 40 years of falling interest rates, which has been a huge tailwind for bonds and stocks. But that tailwind is gone now, and over the last probably 10 years, those falling interest rates have been responsible for 40% of investment returns. In a world with change, the best way to find cheese is to return to the location where you found it originally. In a world with change, however, you want to look someplace new. So when you look at portfolio construction, the old 60-40 allocation of 60% stock and 40% bonds doesn't work the way it used to. In the past, when government bonds were 6 or 7%, investors were quite willing, happy as a matter of fact, to hold 40% allocation to bonds. And when interest rates fell, those bonds appreciated. The issue today is the cost of having a bond portfolio that's 40%. With the way stock returns have been, the cost is too high. So unfortunately, a lot of people today have seen that 60-40 shift to 80-20, and they have much, much less in bonds, and quite frankly, it's making their portfolio riskier than it should be. 60-40 is going to be challenged, and that's one reason why a lot of people are looking at 5% CDs today. But I disagree with the 5% CD as it relates to planning or living through retirement, because there are three issues. One is with 5% earnings, when you subtract taxes and inflation, you wind up with a zero net return. So if you're already retired, you have to be willing to not spend any money. Otherwise, you're going to be spending it on principal. Number two, the 12-month Fed futures outlook is that we will see the Fed funds rate fall from 5.5% to 3.5% over the next 12 months as the economy slows down. And the risk of recession is still with us. And three, another quick story. I was a little older. This time I'm in my 20s. I was a young financial advisor. I had a new potential client sit across the table from me, and they asked for income investments, fixed income investments. And I said, well, I have a 14% money market fund or a 10% government bond. And if that person that I was meeting with had money outside of their retirement account, they would undoubtedly go for the 14% money market fund. If it was a retirement account, they would go ahead and invest in the longer term 10-year long-term government bonds. Fast forward 12 months, that 14% money market fund fell to 9. Okay, the long-term government bond that I bought in the IRA over the next 12 to 15 years had tripled in value. And that's what I see going on today with people's interest in short-term 5% CDs. With short-term government bonds or CDs, when the stock market goes down, there's no appreciation from short-term bonds. Quite frankly, my rebalancing is coming up next week, and in my conservative models, I'm thinking about adding two categories: 10-year government bonds and also utility stocks, because they've been pummeled recently and do yield 5% virtually. The allocation that I have today is not 60-40, it's 50-10-10. 50% stock, 10% bonds, and 10% credit. The difference between bonds and credit is credit has an average credit rating that's below investment grade. So I'm investing at the top end of that. As far as looking at the additional 30% in my portfolio, I have concentrations in value as opposed to growth. I'm about 70% value, 30% growth. And of the 11 primary sectors in the market, this is my advice. Instead of looking at investing in a sector like finance, what you want to do is look at the industry, for example, insurance, which is more profitable potentially than banks. So instead of looking at 11 sectors, when I'm allocating portfolios, I'm looking at about 45 industries I want exposure to. For example, if a consumer has to borrow money to buy a product in a certain industry, I don't want to invest in that industry anymore. Alternative investments. Alternative investments, it sounds mysterious with a name like alternative investments, but basically these are managers that follow trends. So you don't have to worry, well, you always have to worry, but if the trend goes down for the stock market, what you'll find is a lot of these alternative managers will rebalance their portfolio to make money on a strategy that profits when a trend goes lower. They'll also invest in a long short style, which is what I've basically just described. Commodities, they'll invest in currencies. Basically, the average alternative investor has a correlation to the S&P 500 from an average of 10% to 50%. So it does add diversification to your portfolio. Another category that I like is private equity. Now, this is a pretty small doll because not everybody can invest in private equity. It has no liquidity. But one of the advantages of private equity, if you invest following a market correction, the returns from private equity historically tend to outperform the stock market. Now, that may not be true in the future, but the reason that I believe this is true is when the stock market goes down, private equity can go in and buy a private business for much less, and they justify it with a decline in the stock market. Over the past 100 years, the 1940s and 1950s have been a great time to invest. You average 13%. Over the 60s, 70s, and 80s, we had a 30-year period where the market only averaged 3% a year. In the 90s, we again averaged 13%. Then in the 2000s, for a decade, we averaged a negative 1% because of the technology bubble. Okay, let me remember, history doesn't repeat, but it does rhyme. The 2010s were great again, and here we are in the 2020s. Remember, you don't want to be the first one to a mousetrap to get the cheese. You want to be the second mouse. So if you're chasing past returns from technology, it could be that it may be better to look somewhere else for some cheese. I would appreciate the opportunity to be a steward of financial capital for you and your family. Please reach out to me for a second opinion on your portfolio. Thank you very much.